Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The S&P had its first downside in 5 weeks. Ross checks out gold, crude, and the U.S. and Canadian dollars. He also has a special offer for our listeners. Veteran trader Victor Adair checks in from Vancouver Island to give us his take on the stock markets, currencies, and a quick summary of the energy presentation he gave to the World Financial Outlook Conference in Vancouver. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, runs down what's happening with real estate in California, the U.S. as a whole, and Canada. He says Vancouver is the only market he doesn't expect a major downturn in. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always a pleasure, Jim.
Ross, a special deal for our listeners.
Yeah, it's President's Day long weekend in the U.S., and there's a few family days here in Canada, so it looks like it's a good time for a 25% off an annual subscription. That would be for new subscribers, and we're going to offer that. We're coming into a window here where you have a few good opportunities in the year. One of the the really good ones is out there at the end of October into November, where you get the seasonal low and you get some nice moves. And we typically will get our type of signals that we look for: the exhaustions, the capitulations, the sequentials, the technicals that really jump out at us. And now, as we come into the second half of February into March, this is another one of those periods where it's very common to see a market correction. And with the rally we've had, and it looks like some rotation going on, hopefully we get a nice pullback here and an opportunity to give people some timely entry points for the next run on the upside.
How would you describe what happened on the stock markets this week?
Well, we had a bit of a shakeout in the middle of the week. The inflation numbers were such that, there was that scare of will there or will there not be an immediate drop in U.S. interest rates. So middle of the week, you got that hard break. You got a bounce back at the end of the week. But overall, when you look at it, the momentum has started to shift. We don't have nearly the upside that we were having. The S&P ended up here with the first downside week in 5 weeks now. So there's some action going on there. And some of the big names that had been running, the Magnificent Seven, NVIDIA and the group there, they've been taking their time now, just sort of rolling sideways. And if they put in a lower top at this point, you could be looking at a pretty decent correction. And say we haven't had one. There was that good low at the end of October. You had that minor low on the first week of January. And it wouldn't be at all surprised to go back and retest that January low that we had.
What's going on with gold?
Gold, had been stuck in that trading range, very tight one, and it was had tried a few times to break out through the 2050 range, 2060. Couldn't do that on the spot price. But as of this week, it took a nice drop into a sequential 9 for us. That's 9 consecutive days with closes below 4 days earlier. And at the same time, middle of this week, the GDXJ, the mining stocks, they produce the same type of signal. So you would typically get a good 1 to 4 day rally out of there, and the key will be just how things finish off. We did have a pretty good end of the week with both the gold and the GDXJ. So follow through, we'll be looking at pretty importantly here. You can get a second seasonal run that would take us into April. So if you can take out resistance levels just above us, and if we take a look at the other precious metal here, silver has already started to show decent buoyancy. You've got the spot price now at $23.40. We haven't seen a level like that since the first of the year. Nice double bottom down at $22. So silver's trying to make a turn and coming off the bottom. Yeah, maybe the gold and the miners are ready to do the same thing.
What's going on with crude?
Crude oil, the seasonal low, we've talked about this since the middle of December, got this nice corrective retest of the lows in first part of January, then again 10 days ago. And as of this week, we're closing up through the $78.50 to $79 range. So clearly there is that bottoming phase in place. The seasonals are still strong here. And if you take a look at the stocks, the XLE or the XEG here in Canada, those two ETFs are looking pretty darn good. If you take a look at Occidental Petroleum, the one that Buffett has put another bundle of money into here in the last couple of weeks, it's showing a nice breakout off the bottom. So as I say, there's probably some rotation going on. If you look at what's happening, say, with the metals, and you take a look at the energies, pretty good turn there, while the ones that have been running are taking a breather. The one commodity that's just been hammered here in the last months has been natural gas. The weather has been such that demand has been down, and we're at, I think, the lowest levels in 4 or 5 years minimum. We've got lots of good signals this week on the daily charts pointing towards excesses, and this could end up being a V bottom here with a nice turn at the most, or you could end up seeing a tested low. But it does look as though natural gas is making a bit of a turn. And there's some gassy stocks out there. Chenier, LNG might have some pretty good potential. We can see good patterns as far as those stocks are concerned.
What's going on with the U.S. and Canadian dollars?
U.S. dollars had this rally up through the 20 and 50-week moving averages in the last few weeks. Did retrace now just a Fibonacci 61% of the decline from the October high. So we had good upside there. We had capitulation, what we call a super capitulation into the last week of December down at 101, and it's been just a substantial rally up to 105. But with this 61% retracement, probably better off to see it backing and filling again, maybe towards the 103 level. And if we see that, it provides some buoyancy for the precious metal, I would suggest.
Anything shake out of our anything else file?
Well, I mean, the one standout item here of the last month has been this super microcomputer, SMCI, up 1,000% in the last 12 months. It's turned into a $40 billion market cap company. And in the last 2 weeks, we've been getting upside exhaustion signals, which, not surprisingly, I mean, here's the RSI is up to 95 as of the last couple of days. But on a daily, weekly, and monthly basis, the bells were just ringing off in terms of excesses And, it's been going on really for about 2 weeks. And at the end of the week was the reversal day. Looks as though that index, and you've got a hard time to go back and find anything that's like this, that's had a run of that magnitude, especially with a market cap of this size. You might find it in some of the junior stocks over the years where there was a real squeeze on some of the shorts. But for something of the size of SMCI, this is really a 1 in a million. And if anything, it sort of looks, it blows away what happened to the Bitcoin when it hit 60,000, and blows away anything back in the .com era. If you look at AMD or Cisco or Microsoft back in the 1990s, they never had runs that were this far and this fast. So this one definitely way ahead of itself. Topped out at over $1,000. This was $100 a year ago, and at this point, looks like pretty hard correction and then consolidation. And it's not for the faint of heart, but just to show that the type of activity that we're seeing in this whole artificial intelligence and computer aspect of things, in terms of how fast things are moving. It's just one to really be amazed with right now.
Ross, again, how can we get that special offer?
Chartsandmarkets.com, and on the front page there will be a link for a annual subscription, 25% off. Look to take advantage of the opportunities that we think are going to come up in the next few weeks.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at ChartsByRoss. Coming up, Victor Adair, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia, but he's still very active in the markets. He's speaking to us from Parksville. Check out his website, victoradair.ca. Welcome back to This Week in Money.
Jim, it's always a pleasure to talk with you. Thank you.
Victor, well, you've been actively trading in the markets now for over 50 years. I said nearly. Well, now it's over 50. Before we discuss individual markets, what's at the top of your mind right now? The markets are getting toppy, are they?
Well, yeah, that's a good top of mind. The markets are toppy. We've had an incredible run in stock markets, not only in the United States, but also in Japan, in Germany, Mexico even. One of the places we haven't had a hot stock market has been Canada, but prices are up here. And then when you look at Japan, I should say China, I mean, the stock markets have been down. Actually, I think we touched about a 5-year low last week before they took a week off in China. Anyway, I guess really what's top of mind for me is I think we are frothy, to say the least, in the stock market. There's all kinds of signs there. I think if I look at what we would call retail, I used an expression the other day, I'll repeat it here. It looks to me like retail is buying lottery tickets in the casino. That's the kind of feeling I have. For instance, we have a company here called Super Micro Computer that has rallied from about $300 a share to $1,000 a share just in the last 3 weeks. It's that kind of action that we see also, say, in the options market, where retail is literally buying lottery tickets, where they're buying options that expire the same day, looking to get a pop one way or the other. The Dow and the S&P have closed higher for 15 of the last 16 weeks. That is a 50-plus 12-year record. I think it was 1972, the last time we had the Dow do better than closing higher for 15 of the last 16 weeks. So there is that casino kind of feel to the market. On the other side, volatility here is historically low. I think that's a sign of complacency in the market. Markets go up, and that's what they do. And I would say also heavy option selling. I see Wall Street rolling out more and more product these days where, it's a bond fund or it's a stock fund, but they get extra juice by writing options against their positions. And then, with the retail lottery ticket crowd, selling puts looks like free money. That the market only goes up if you sell puts, you just get the money. One of the things I noticed on the option side as well is that puts and calls that are equidistant away from the strike price are trading at about the same price. In other words, if it's $6 for one, it's $6 for the other. Why that's unusual is historically puts that are the same distance away from the strike price as calls are more expensive because there is a greater risk of the market, say, taking a sharp break than the risk of a market taking a runaway to the upside. So given that the market has run away to the upside, maybe it's not surprising to see that the puts and calls are priced about the same. My last thought on that, I guess, is that I think the market's toppy. We're not talking about giving people investment advice here, but you might want to think about it. I posted on my website last week, by the way, Bob Farrell's 10 rules of trading, and kind of a common theme within those 10 rules would be when a market goes racing to the upside, it doesn't correct by going sideways. And I just think there's some risk here that we could have a breakdown. And if you have a portfolio of stocks and you don't want to sell any, but you're also a little nervous about it, you can buy index puts, you can buy ETF puts, as it were, and they're dirt cheap here compared to what they would have been a month ago or something like that. So that maybe is a way to get some insurance on a portfolio. Why is there a possibility of a downturn? Well, we've gone up so far so fast. There's that. Interest rate expectations have changed dramatically from what they were, say, in December. Back in December, the market was expecting 6 cuts from the Fed by the end of the year. Now we're pricing in barely 3. And here's another mechanical thing. A lot of the money that's run in the market, this is by people who are managing other people's money, is run on kind of a mechanical program. It could be a trend-following program or something like that, but if the market's going up, they buy, and they keep buying the more the market goes up. If the market turns down, that crowd, and that crowd, by the way, would represent billions and billions of dollars. If the market turns down, they have to start to sell some. So you can easily see where some selling could lead to more selling, which leads to a bit of a domino effect. We haven't had so much as a 2 or 3% correction since October. What other thoughts have I got on that? Seasonality, that comes to mind. Seasonally, and I'm not a big fan of seasonality, but I pay attention. Seasonally, like over the last 20 years or so, the market is weak. The stock market is weak from mid-February into April, and also during this period of time, we usually get a volatility spike. So, those are some things to watch out for. So I guess, Jimmy, if I could answer your question in one sentence, I'd say I think the markets are getting a little frothy here, and I'd be careful.
In last week's Trading Desk Notes, you noted there's been a significant correlation breakdown between different markets. What does that mean? Why is that important, and why has it happened?
Yeah, let's look at the period from October to December. Now, in October, markets had been trending down since, I think, when I say markets, I'm going to say the stock market, had been trending down since about August. Bonds and stocks actually had both been going down, and we had a pivot right at the end of October. And the pivot was kind of broadly predicated on the idea that the Fed and the other central banks, but they hardly matter compared to how important the Fed is, that the Fed was done raising rates. Well, in my Trading Desk Notes for the last, year and a half, I've been writing words to the effect that once the market had the idea that the Fed was going to stop raising rates, that would be like a green light special to buy the market. Well, I mean, it sure was. We had the Dow up about 6,500 points or so. That's about a 20% rally in the Dow, and other markets going up as well. Certainly the tech stocks led the rally. But, we had that rally in the stock market from, call it, the end of October right into December. And during the same period of time, the bond market was rallying. Foreign currencies were rallying against the U.S. dollar, and the gold market was rallying as well. So just everything, as it were, going the same way. Since December, the stock market has continued to rally, but the other markets have turned. The bond market has been trading down. The foreign currency market's been trading down. The U.S. dollar has been going up, and gold has come down as well. So why the turn? I think there's always 16 different reasons, and you might guess the right one. But my guess would be that the change has been in expectations on interest rates. As I mentioned earlier, in December, the market thought the Fed would be cutting rates 6 times, even though the Fed made it clear, that they thought maybe they'd cut it 3 times. Well, since at the end of December, the market has come around once again, reluctantly, to embracing the Fed's idea that there'll be 3 cuts, and that's barely priced in. So I think that has given the dollar a bid, which puts pressure on gold. And the interest rate market as well, I think it had got ahead of itself in December. I'm one of those old school types on the bond market, by the way, that I think the market is looking at an avalanche, a tsunami, whatever you want to call it, of issue coming this year, as the governments have clearly given up even making a pretense of balancing the books, and they're just going to run deficits, and they're going to finance the deficits by issuing paper, issuing bonds, which, by the way, is going to depreciate the purchasing power of all currencies. So, I think that's been the reason that we've made that correlation breakdown between the last 2 months of last year, the first 2 months of this year. And I think the significance there is the stock market might be running on fumes here, not paying attention to the interest rate change while the other markets have been very much focused on that.
In our discussion last month, you thought the U.S. dollar would continue to rise. It has. What are your thoughts on the currency markets now?
Yeah, my old saw that I've had for more than 40 years on the currency markets is that capital comes to the United States for safety and opportunity. And that is absolutely the overriding thing that in my opinion, that dominates currency flows. I mean, it'll obviously fluctuate from time to time and all that, but that is really when you're the reserve currency, and America sits in American exceptionalism and all that kind of stuff. The opportunities in America. I mean, they just do not have tech market capitalization, for instance, in other parts of the world like they have in America. You look at the difference even between the Toronto Stock Exchange and the American markets. They've been much stronger, and the American stock market has totally outperformed everything else in the world. So there is that. Relative interest rate differences are always important, and unless one country is just having a real problem with runaway inflation, say like Argentina used to be, then they can have the currency going down while interest rates are going up. But that's usually a very important thing. On a shorter-term basis, the last year or so, really the dollar has just been going sideways, chopping up and down in a rather wide range. And yes, it's traded higher the last couple of months. I guess my default position would always be I'd buy the U.S. dollar, and I'd need a real good reason to not do that. So that's kind of my thinking on the U.S. dollar against the Canadian, against the euro, against the Japanese yen, whatever. And mentioning Japanese yen, I mean, the stock market there made its all-time high in 1989. We fell about, 80%, I guess, over the next number of years. Well, it's rallied back almost to those highs. And one of the things that's helped the Japanese stock market rise is that over the last 12 years, the Japanese yen has fallen in half against the U.S. dollar. So if you're going to be a tourist and you want to do something a little different, look into going to Japan. You're going to find it's cheap there in U.S. dollar terms anyway, because the yen's so weak, and a different kind of place to go than you might go otherwise.
Officially this week, Japan fell into recession. So did the UK. What kind of an impact is that going to have on us?
Well, I've got on my notes here that China is in recession. We've talked about that. I mean, China is China, I remember 4 years ago delivering a speech, and I said, I keep waiting for China to follow the same pattern that Japan did in the late 80s, where they had this tremendous run-up, and then they hit a tipping point, went the other way. The real problem with China has been too much leverage on the real estate market. I mean, massive leverage. And, of course, they got an authoritarian government there that if you disagree with them, you just disappear. Yeah. So that's a tough place. Foreign investment has gone away from China. Sorry, I'm off topic there a bit, but China is another country that's in recession. Japan, Germany, the UK, I think Canada, too, actually, is in recession. The two important countries in the world that don't seem to be in a recession right now are the United States and India. If the depression almost, that's too strong a word, if the deflation that's happening in China, which is already being exported to Europe, starts to get exported to the United States, and we could have a slowdown, a global slowdown. But I'm a little shy to say that because there's been some really smart people for the last year and change who've been forecasting a recession, and they've been wrong. But yeah, it's closing in on Fortress North America.
Gold made all-time highs in December, but has backed off about $100. Is gold being ignored with everyone focused on the soaring stock market? And I have to say Bitcoin as well.
I think you're right. Yeah, I think that's exactly what's happening to gold. It's been, it was at all-time highs, $2,100 or thereabouts in early December. I look at some of the internals. I see, for instance, the gold ETF market, where people are buying ETFs that hold gold bullion as opposed to ones that hold shares in gold mining stocks. That has been net sellers for the last 3 years, save for a brief period of about a month at around the time when the Russians invaded Ukraine. And then there was another spike when Hamas went over the border and attacked Israel. But basically, yeah, they're just losing assets, as it were. When I look at the open interest in the gold futures market, same sort of thing. It's like dull as dishwater. And, why bother with gold when you've got more excitement in the stock market or, as you say, Bitcoin? Now, we're really only a hair away from all-time highs. The $100 when you're talking about $2,000, it's not much of a decline. But, yeah, gold seems to be ignored. And I tell you what's really ignored is the gold share market, and especially the gold share market for junior companies. I think it must be really tough to try to raise money out there these days if you're a junior company exploring for gold. People go, why would I give you my money when I can buy into a computer stock and it'll double overnight? So, yeah, it's a tough market for gold. The strength in the U.S. dollar since December hasn't helped. The rise in interest rates hasn't helped. So, yeah, I don't know, maybe gold is an opportunity here, but it truly has been ignored lately.
Recent inflation reports seem to indicate inflation is not falling as much or as quickly as the central banks would like it to. What are your thoughts on big, bad inflation?
Yeah, I guess my, I'm going to call it my intuition. I think as a trader, I'm bombarded with information all day long, even in my sleep, I suppose. Certainly, 7 days a week. And you just kind of, maybe you can't even enunciate, what all of those opinions are, but you just kind of develop a feeling. Somebody's called it a spidey sense and this and that. But anyway, I'm trying to identify that thing, that intuition. And my intuition has been that inflation is not going to go back to 2%. That with government continually running deficits, which depreciates the purchasing power of currencies, which to me is the essence of deflation, when your currency buys less than it used to, that just wasn't going to happen. And there's kind of a game of catch-up that happens. When one group of workers sees another group of workers go on strike and get a big wage increase, well, then, they want it too, and then everybody else says, well, we want it too because we have to keep up, with the other guys. And the same thing on the pricing side. People are selling stuff. They need a bigger profit margin because their expenses are up, and on and on and on it goes. So you get into like an inflationary mindset, or you may call it a vicious cycle. And I just don't see it going back to 2% for sure, that central bank target, without, there's the caveat, without a recession. So, the CPI number early this week and then the PPI number later in the week were both disappointments. The bond market reacted, as you might expect, particularly on the CPI number, traded down, and I'm not surprised. I think inflation is going to be with us, and it's the insidious stuff. I mean, I think people know that the stuff that they want to or need to buy is going up in price more than the CPI says 4%. Well, that's just not reality for a lot of people. Whether it's even auto insurance, trying to buy a house or pay your mortgage and so on, it's going up by more than 4%.
And with the central banks expecting inflation to instantly fall as soon as they hiked rates, both you and I lived through the 70s, early 80s when inflation was rampant, and it took nearly a decade to wrestle it to the ground. I also remember your employer would give you a cost of living bonus every 3 months, and I don't see that happening anymore.
Yeah, well, I don't even have an employer.
Yeah, both of us.
Yeah, I mean, Paul Volcker took short rates to 21%. The Fed's taken short rates all the way up to 5%. Wow, and I don't know, honestly, if it's the same world anymore, that if they take the interest rates up to 10%, what that does. But as I said, I think we don't get inflation down without getting a recession. And perhaps if they took interest rates high enough, they could trigger a nasty recession, and then they'd look like they, scored an own goal, as the Brits like to say.
The retail sales report from the U.S. was much weaker than analysts expected. What's your take on that?
Yeah, I've got a kind of an unpopular take on the retail sales number, and I'll put it to you this way. I think our society is getting increasingly bifurcated. There's sort of a dividing line. You're either on one side or you're on the other, and that's happening in so many ways. But at a financial level for consumers, I saw the chairman or whatever of McDonald's spoke recently, and he says, "Hey, our sales are down. We're finding people," and he's implying, people that, when they're dining out, go to McDonald's, okay, that this is the lower quartile on the income scale, that these people just aren't coming as much as they used to. So I think that the people out there that are, and this is probably a politically incorrect thing, but are getting left behind financially, are getting further left behind. In other words, the people that are enjoying the effects, what they call the wealth effect, of owning real estate, of owning stocks, are doing fine. They're keeping up with the Joneses and the rising prices and all that. But people who don't own real estate, who don't own stocks, who are, trying to probably holding down 2 or 3 part-time jobs to try to make ends meet, they're struggling. And so the economy is, I should say, the consumer is not this monolithic thing. It's, broken into these different subsets, and some of the folks are struggling. Now, I see there's over $1 trillion, I think it's about $1.1 trillion in credit card debt. That means that people haven't paid off their credit card, on the monthly basis. Now, I'm thinking like people that are earning a good income pay off their credit card bills every month. So people that are struggling don't. And with interest rates, we're north of 20% now, the interest that's charged on consumer credit card unpaid debt. So I'm thinking that the breakdown in retail sales is not a surprise to me, given what I was just saying about, I think, people know the prices of things that they need to buy or they want to buy are going up more than the CPI, and we're having this bifurcation. Now, that's going to have ramifications. If it broadens enough, maybe that triggers a recession. It's probably going to have political ramifications in the States. Let's say the people that are getting left behind again, there's that term, pardon me for if it's too coarse, but maybe they're more likely to vote for Trump than they are for Biden. I think it's happening, and I think it's important. I'm not sure how it's going to play out.
2 weeks ago, you were the lead-off speaker at the World Outlook Financial Conference in Vancouver talking about the energy markets. Can you give us a quick recap? What did I... Let me see. In a couple of words, the global energy demand, I think, is going to keep growing. But some of the key questions are going to be, where does that energy come from? How's it going to get delivered? And here's the tricky one. Who is going to decide how it gets used? I described energy as a story of transitions from, when people discovered fire, when they're living in a cave for heat and for light. We're using technology. We've come to the point here where billions of people around the world now can access electricity just to the flip of a switch. That people, the transitions, I guess, that people go through, you can see it almost like a food chain. As people become more affluent and have greater access to technology, they go up the food chain in terms of what energy they get and how they use it. My friend Joseph Schachter, who I know you interview frequently as well, I attend his conferences over in Calgary every October. He really likes to make the point that the emerging and developing markets are going to be just a vast new source of energy demand. There's over 1 billion people in the world now who do not have electricity. And the people that are in these emerging and developing markets, they want to have the kind of life, as it were, that, the people in developed markets like us take for granted. So, we're going to see demand for energy there. Something that I thought was really top of mind for everybody, but it's difficult to talk about, is the contentious debates that we're going to have. I just kind of made a point here about who will decide how energy gets used. Well, I tell you, I think people have this notion, and I don't think they're wrong, that the governments are becoming more and more bossy as they mandate, how energy policies, who's going to get this and who's going to get that, and so on. And I think there's certainly in my mind anyway, I kind of enjoy seeing all these tractors hitting the road in Europe, or the truckers convoy we had here in Canada, where people are telling the government, "Go to hell." We don't like your ideas. So we're going to have contentious energy negotiations. And Jimmy, there's something that came to mind the other day, and I thought, wow, hadn't I thought about that before? But the guy was making the point that the boomer generation is less likely to be worried sick about the climate crisis, whereas the younger folks, that seems to be much more front of mind for them. So maybe I'll just leave it at this. One of the things that I said to people is when you're thinking about energy, if you want to be investing in energy, and I think there's just incredible opportunities in energy, everything from buying a pipeline company that pays dividends to getting into some company that's virtually space-age technology that they're developing for some aspect of the energy markets. There's just such a huge range of things. But in terms of the contentious debates that we're going to have going forward, I remember an American philosopher called Thomas Sowell, and one of his most famous quotes is, "There are no solutions. There are only trade-offs." And how I take that is that nobody gets everything they want in negotiations. So with these contentious debates, as I'm calling it, there's going to be some people pulling their hair out, saying, this is crazy, that's crazy, but that's what it's going to be like, and that's going to impact price volatility in the energy markets. So if you're trading those markets, you got to be prepared for that kind of volatility. We usually only talk about financial markets, but is there anything in the commodity sphere that's on your radar?
I scan hundreds of charts every day on my computers, and I'll just laugh and say, how the hell did I not see that? Well, the cocoa market has just gone nuts. Just raced to the upside. I mean, it looks like one of these, serious microcomputers or whatever it was. I mean, the cocoa market's just soared to new all-time highs, so far above wherever it was before that it's just shocking. Of course, I don't look at cocoa every day. I might look at it once a month. So no wonder I missed it. But the problem there is the classic in the commodity market, the supply demand. Most of the cocoa in the world, I'm going to ballpark it at 70% or so, comes out of Ivory Coast and Ghana, right next to each other in West Africa. And they've got some problems with, they got some disease or something wrong with the cocoa plants, and all of a sudden there's a shortage of cocoa, and it's spiked like crazy. We just went through a similar thing with orange juice, where I think it quadrupled in the course of a year. And I was always puzzled about that, because when I'd buy orange juice at the grocery store, how come the price hasn't gone up? Whatever. But the natural, I should say, the wholesale price of orange juice just skyrocketed, and it's still way up there. And here's my favorite one, I think, Jimmy, in terms of pointing out something that you might not have seen, is natural gas, traded in the NYMEX in New York, traded to a 20-year low today. And I talk about this in terms, I wrote it in my blog last week, in inflation-adjusted terms, I don't think natural gas has ever been as cheap as it is now. And I mean, this is wonderful for people who want to use natural gas. And I think the supply-demand story here is that they're having such success with the drilling programs, particularly drilling for oil, and they got natural gas as a byproduct, that they've got more natural gas than they can distribute, can get rid of. They haven't got the pipelines to take it away. So in places, and people in the natural gas business know this, from time to time in different places, natural gas prices actually go negative, like crude oil did back in April of 2020. Anyway, so cocoa, orange juice, and natural gas, you can't keep up with everything that's going on out there.
Listeners have free access to everything on your website, VictorAdair.ca, where you post your weekly trading desk notes. Is there anything we want to look at that maybe we haven't mentioned yet on your website?
Oh, well, the weekly trading desk notes are, and I usually write those every Saturday and get them up on Saturday night. But I've got a section there on, I think I call it recommendations or something like that. And I probably have, 100 market-related books and, different analysts that I pay attention to. For instance, we were just talking about, I made my speech at the World Outlook Conference about energy. And I gave the audience the names of 3 of my favorite energy analysts, and they would be listed on my website. Particularly books, websites, and that sort of thing. And by the way, those 3 are Doomberg. I'm just amazed at what's happened to Doomberg. I think he has the most successful, in terms of number of subscribers, Substack site for anybody in finance. Robert Bryce, who I think is I really pay attention to Robert Bryce. He's out of Austin, Texas, for his take on the grid. There's energy. There's, whether you're going to have an electric car, or you're going to have a solar panel or whatever, but then you got the grid, all the wires, and there's something like 6 million miles worth of wires that try to connect energy from maybe where it's sourced to where it gets used. And as he's constantly pointing out, this grid has a lot of vulnerability to it. I mean, he's not a doomster. He's a guy that's saying, hey, we got all this. And one of his favorite transitions would be, we go from natural gas, we've got to use natural gas now, and we transition to nuclear in the future as our primary source of domestic energy in North America. And speaking of that, I just remember looking this morning that coal usage around the world is just hitting new all-time records, and of course China is just unbelievable uses unbelievably more coal than anybody else, probably everybody else put together, actually. I think it's about 50-50. Anyway, Jimmy, I'm saying that on the recommendation pages there's books and websites and people I like, and people might want to look at that besides just the trading desk notes.
Victor, thank you so much for being on This Week in Money.
Jim, it is always a pleasure. Thank you kindly for having me on.
My guest has been Victor Adair, speaking to us from Parksville on Vancouver Island. Check out his website, VictorAdair.ca. Coming up, Robert Campbell, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated, trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell. He's the author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter, online at realestatetiming.com. He's speaking to us from San Diego, California. Bob, welcome back to This Week in Money.
Thank you very much for having me.
When does the next issue of the Campbell Real Estate Timing Letter going to be published?
It will be published in March 15th, 2024. I publish it once every 2 months, 6 times a year.
How's your book, Timing the Real Estate Market, doing?
Excellent. I wrote it. I discovered a formula 23 years ago, and it works as well today as it did then.
Does it look like we're headed for a recession this year?
That's a great question. And I have a great response. No, we're not going to be in a recession. And here's why. I mean, my favorite recession indicator is what's known as an inverted yield curve, and it comes in a variety of forms. But the one I watch most closely is when you take the yield on the 10-year Treasury note and subtract the 3-year Treasury bill yield, and you get a figure. When that number is below zero, that meaning that the 3-year Treasury bill has a higher yield than the 10-year Treasury note, which is very abnormal, that means the system is messed up, the banking system's messed up, the yield curve's inverted, and a recession is on the way. Now, the reason I follow that so closely, you go back like 50 years, every time that yield curve has been inverted, a U.S. recession has followed without exception. So that has a track record comparable to no other. So about a year and a half ago, that yield curve became inverted for the first time since the recession of 2020, which the inverted yield curve predicted that too. Even though that was an extremely short recession, the yield curve, inverted yield curve, predicted that. It also predicted the 2007-2008 great financial crisis. It also predicted the dot-com bust in 2021. It also predicted the 89-91 recession. So its track record is second to none. Well, we went negative on that a year and a half ago, and the recessions always occur not after it goes negative, but once it goes negative and then returns above zero, so the yield curve uninverts. That hasn't happened. In fact, what has happened since then, it started retracing itself back toward the zero line, which meant that a recession would be coming, and now it's heading back down again. So until historically speaking, until that inverted yield curve passes back above the zero line and is uninverted, we're not going to have a recession. And I know that sounds kind of technical, but that's just the way the world works, guys. And so that, we are a long way away from that. I mean, you only get monthly figures on that. So it's very unlikely that, because it's so deeply inverted right now and heading down, not back up, that a recession's unlikely based on that technical indicator. Other reasons, equally important. This is a presidential election year in the United States, and the political power in power has the ability to strong-arm things, make things look better than they are in order to avoid a recession in a presidential election year. Why is that important? Since 1924, no incumbent president has ever been reelected in the presidential election year if there was a recession? Zero. So they will do everything possible to keep the economy out of recession. And how are they doing that? They're not doing that today by zero interest rates, which they can't do with the inflation rate we have nowadays, which, by the way, has been ticking higher the last couple of months. The way they do that is the way they're going to stimulate the economy is with deficit spending. The U.S. ran a $2 trillion deficit in 2023, and we will run at least a $2 trillion deficit in 2024. And that's highly stimulative because we're spending $2 trillion that we're not collecting in tax revenues. And what does that create? Jobs. And it keeps, and that deficit spending, it jacks up the GDP, gross domestic product numbers. And so they'll continue that because that stimulates the economy. And it looks now like the Fed may be leaning into cutting rates as opposed to continuing to raise rates. But that likelihood is becoming questionable at this time because inflation, the rate of inflation, is rising again. It's not continuing to go down. But nevertheless, if the U.S. wants to juice the economy, they're going to do it with deficit spending. One, they don't have a choice. And two, it's very stimulative because it creates jobs, puts money in people's pockets. The unemployment rate in the United States is still near record lows, 3.7 or something like that. That's very, very low. So for all the reasons I've just stated above, the U.S. will not have a recession in 2024. And the reason that's such an important topic, everybody, is you keep hearing about it on the financial news networks. Are we going to have a recession? Will it be a hard landing or a soft landing? Over and over again, that's all they talk about. Oh, well, if the Fed raises rates, it's going to be a hard landing. If they back off, it's going to be a soft landing. I take exception to both of those. I don't think we're not going to have a recession in 2024.
Is the potential for higher inflation and higher interest rates kryptonite to the housing market?
Not really. Housing prices, if you look back over the long periods of time, housing prices can go up during rising rates, and they can go down during falling rates. And it's because it's all driven by demand. If you have a really, really strong economy, interest rates are going to go up. So if you have a strong economy, housing prices are going to go up. And the reverse is true too. In fact, during the last two housing downturns in the U.S. during 2006 to 2012, 30-year mortgage rates went down 3 percentage points. And in the prior recession from 1990 to 1996, housing prices, fell nationwide, and in California, mortgage rates fell 2 percentage points. So everybody focuses on interest rates and mortgage rates. Like, that's the indicator you should watch. I identified 5 key indicators in my book, Timing the Real Estate Market, out of 25 that I looked at that are predictive of future price movement in the housing market, and interest rates were the least predictive. It's still a valuable indicator to follow, but it's the least predictive. The most predictive, however, were existing home sales, new home building permits, mortgage defaults, and foreclosure sales. But nobody even talks about those. I mean, they talk about home sales and building permits, but everybody's focused on interest rates. Like, if interest rates would go down, even though housing prices are at record highs and affordability is at record lows, maybe we can get another 10 to 20% home price appreciation out of this cycle before the crash starts. That's pure speculation. There's no evidence supporting that kind of theory.
Are the numerous interest rate increases hitting Main Street and the housing market?
Well, they're not hitting that. They're hitting the housing market, yes. The answer is yes and yes. Let's talk about the housing market first. They're hitting the housing market because demand, existing home sales, are down like 50%, 60% from their all-time highs. You know, so why haven't housing prices crashed? Because the supply of homes is down 50 to 60%. While demand is down. So in other words, supply and demand are still in equilibrium. And that's why we haven't seen a major correction in housing prices yet. Because if you go back through time and look at housing affordability charts that go back 50 years, every time housing gets super unaffordable, like it is now, there's a correction in the housing market. There's it. I mean, a big correction in the housing market. We are more unaffordable than we've ever been, and housing prices are still holding their own. Why is that? There's no supply. So that in theory, let's say that housing demand could drop by 90%. Let's really exaggerate the numbers here. 90%. And if the supply of homes on the market for sale declined by 90%, you're still in supply and demand equilibrium. Housing prices don't have to go down anything. And that's where we are right now. And with respect to the consumer, balances on credit cards are rising faster than they should, as are delinquencies. So inflation has put more people it's created more trouble for people than people like to realize. I will say, however, though, the people that are having the most trouble paying their credit card balances and making monthly payments are poor people. People at the lower echelons of the income ladder. Rich people aren't having any trouble, but the poor people are, which make up the majority of the United States, of course.
Banks are starting to go under. Are we likely to see more and more credit constriction ahead?
I don't even like to comment on that because the Federal Reserve, the bankers rule the world, okay? They do. And the Federal Reserve, if it has to come in and bail out the banks, I don't care how poorly they've been managed, how bad their loans are, the banks are going to get bailed out. So that, yes, that banks have pulled back on their lending, definitely. It's harder to get loans right now, that's for sure. But will the banks go under? My guess is no. Every one of them is going to get bailed out.
What's the state of the U.S. housing market?
Right now, nationally, statistically, it's maybe rising at a year-over-year basis. On maybe 5% a year, home prices. But that's misleading because after they peaked out in mid-2022, housing prices went down for like 6 months. Now they're starting to go up. So today's numbers are being compared against numbers from a year ago when housing prices were lower than they are now. But in the United States right now, housing prices are maybe 1 or 2 or 3% above their mid-22 peak. That's it. And the only reason they're above their mid-22 peak is there's no houses to buy. But that will change. Something will change that, guys. That's not. Have we ever had this situation before like this? No. I mean, so does that surprise me? No, not at all. Every cycle is a little bit different than the last cycle. If you think, oh, this has to happen. No. I mean, do the cycles have to happen? Absolutely. If I showed you a chart of real estate cycles going back 50 years, and they go up, they go down. They go up, they go down. This one's gone up and it hasn't gone down yet. Do you think that it's not going to be different this time, guys? Because unaffordability is a huge, huge factor. When you can't afford a house, soon as the supply hits the market, something will happen. I don't know what's going to happen. But supply will come back in the market, and then supply is going to overwhelm demand, and prices will go down.
What is the state of the California housing market?
California housing market it's holding its own. That it's a little worse than national. I mean, there's certain markets in California that are doing very, very poorly, such as the Bay Area, San Francisco. I mean, they got problems it would take an hour to describe. But, however, certain markets, like where I live, San Diego, is one of the hottest housing markets in the United States. And can I explain why? No, I can't explain why. Why does it matter? Only what matters. So but do I expect that to continue? I mean, that San Diego housing prices will just keep going up forever and ever? No, not at all. A huge correction is coming to all these markets. So California is it's not bad yet by any means, but it's not good either. So that's the state of the California housing market. And interestingly, what's changing is what I like to do with any market, housing prices, I like to adjust for inflation, CPI. And even though the government CPI numbers are completely fake, it's the best you got, and I'm going to use them. In the United States, when you look at the U.S. housing market, that adjusted for inflation, from the peak of the market in 2006, it took 15 years to get back to break even on an inflation-adjusted basis. And why is inflation-adjusted basis important? Because the dollars in your hand are only a symbol of wealth. What they will buy, purchase in the form of goods and services, is real wealth. So I don't care if you're making $250,000 a year because of inflation. You work at Jack in the... people in California right now are working Jack in the Box, fast food. They make $20 an hour. $20 an hour. You know what skill it takes to work at Jack in the Box? None. You could train monkeys to work in Jack in the Box, but they're getting $20 an hour nowadays, or $40,000 a year. But what will that money buy you in goods and services? Will it buy you $40,000 in goods and services, the same goods and services that it did 10 years ago or 15 years ago? No, a fraction of that. So anyway, back in the United States, it took 15 years to get the purchasing power of if you sold your house, the purchasing power, the money that was left over after you paid the mortgage, 15 years to get back to break even. In California, however, it's been a 17-year round trip to nowhere. We are still not back on a purchasing power basis where we were in 2006. So anybody that sold their house in 2006 and still is in cash, still is in cash, and let's say they didn't do anything, which is not the preferred way to make money in real estate, they'd be better off, assuming they put their money in something else, that didn't also go down in value. But so we're at 17 years and running. People that have owned real estate in residential real estate in California, people trying to get back the purchasing power of their money. That's pretty amazing to me.
With so many people leaving California, how has the housing market been able to stay afloat?
It all goes back to supply. There's no supply. Who's leaving California? Are poor people or rich people leaving San Diego, leaving California? Rich people. The taxation is getting crazy. The politics is even crazier, and so people are leaving. They're leaving at a record rate. And so, but the housing prices have still maintained itself because I don't care how many people leave, if nobody puts their house on the market, prices can't go down. They can't. So it's not.
What are your leading indicators for home prices showing?
Well, right now, existing home sales, both nationally and in California, the trend is down. Hard down, and that's because that's one of my first leading indicator, and the reason that was chosen. If you charted existing home sales over housing prices going back like 50 years, the correlation is extremely strong. Existing home sales go down, housing prices go down. Existing home sales start increasing, housing prices start going up. The correlation is maybe 90%. It's that strong. Building permits. Building permits are holding up better than existing home sales, but they're still weak. And again, take that 50-year chart. Go back 50 years and plot new home building permits against home prices. It's a leading indicator. Building homes is a leading indicator of the economy because the home building business and everything that's involved constitutes 15% of the U.S. economy. So that's there too. and go back and look at a chart showing that mortgage defaults. Compare that against home prices. Correlation is 90%. Foreclosures, 90%. Interest rates, no. But so all the leading indicators right now are saying housing prices should decline, should be declining, but they're not.
Is the months of inventory for housing growing?
Slightly. It's starting to grow. It's not going down anymore. Now all of a sudden it's kicked up, especially in the U.S. housing market and California. There's a chart pattern that I use that I rely on very strongly because it has a very high probability of being correct. And it's what I call a 1, 2, 3 highs and 1, 2, 3 lows. That chart pattern predicts reversals to both the upside and the downside. And we had a 1, 2, 3 low in supply of homes on the market nationally. And if you just look at, okay, how successful has that indicator been if you look at 100 different entries? I would say 80%. You got to go with that. You got to go. It's an amazing statistical advantage that you have, and that's why I apply some of my technical tools to real estate charts because they're extremely reliable. So, but house inventory is increasing. Homes on the market are increasing. They're not decreasing anymore. As long as the months of homes on the market for sale is under 6. And right now it's around 3.5. As long as it's under 6, that supports housing prices. When it gets over 6, it doesn't. So how long is it going to take for that indicator to go from 3.5 to 6? Who knows? It could be a long time because it doesn't move very quickly. So we could be stuck in this market where housing prices are, no falling demand, falling permits, foreclosures are going up. People are defaulting on their mortgages, but there's no houses on the market. We could essentially be going sideways for a while longer, maybe a year, before all of a sudden that supply catches up with falling demand, and then of course is when we start going over the cliff.
Would higher inflation and higher interest rates be bullish for stock markets?
Typically, yes. The stock market tends to be the best inflation hedge of any asset class. Typically, the stock market appreciates at about a 5.5% above the rate of inflation. Real estate, U.S. real estate, on the other hand, nationally appreciates at about a 1 to 1.5% above the rate of inflation. California real estate, even though it's extremely volatile, is maybe double that. It's maybe in the 2 to 3% range. So in the long run, California, is there any better place in the United States to be than in California real estate? Not that I know of. I don't follow Vermont or something, those places like that, or, Montana, because they're such small markets. Nobody lives there. So, and the sample sizes are so small. But California real estate long term is a far better investment than U.S. real estate long term. And before I forget about it, everybody, that I don't know how many of you viewers are from Canada, but I've looked at some charts on Canada. The Canadian housing market has been extremely strong for decades. With even during the downturns, they've been very modest. Based on chart patterns that I'm using, I've looked at the Canadian housing market, the chart patterns that are produced by Wolf Street, which are great. The Canadian housing market right now nationally is hanging on a thread. Certain markets, they're poised to start heading lower based on this 1, 2, 3 chart formation that I use. That they're just hanging on a thread. In some instances, they're just a little bit below it. The strongest market that I see that is still showing strength and not showing weakness is Vancouver. That's the strongest housing market in Canada. And I still see that where, that I'm not ringing the alarm bell yet for Vancouver at all. Well, I am ringing the alarm bell for that national home prices in Canada collectively.
When interest rates hit their final peak, does it become bearish for the stock markets?
It does. And interestingly, everybody's going, when the Fed starts cutting rates, yes, the stock market's going to take off like a jackrabbit, like it hasn't already. But it's exactly the opposite. When the Fed starts cutting rates, that's when the stock market's going to go down. And that's just a historical lesson. Looking at the lessons of history, that's what happens.
Do you have any health and fitness tips for us?
Just take care of your body, everybody. Take care of your body. Here in the United States, I just looked at the latest statistics on the on Medicare and Social Security, and what's taken in every year in revenues and what's going out. Right now, Social Security, just to help you with the contrast, is 15% underfunded. 15%. We can live with that. We can change that. Just up the retirement age a little more or something like that, or add a little more in taxes. That's okay. Medicare, which people over 65 rely on for their health care, it is 84% underfunded. 84%. And that's one of the reasons that these U.S. deficits are baked into the cake. They can't allow that to happen. So with respect to health and fitness, everybody, that everybody has control over their own health. And it's your responsibility to take care of that if you're living here in the United States, because who knows what's going to happen to the system, that it becomes really, really hard to get an appointment because people aren't being paid, or inflation picks up because the government still has to run these huge deficits to cover the 84% shortfall, in Medicare. But the point being, you have a responsibility to yourself to take care of your health. Don't rely on anybody to take care of it for you. And especially the fact that Medicare is a failing system. Failing. 84% underfunded. And are any of the U.S. politicians talking about that? Not any that I've listened to, but I don't listen to any of them because I don't believe one word they say, or usually whatever they say, I take the opposite. But no. So now even more than ever, good health and fitness stand on its own two legs under any circumstances. They will make your life infinitely better. It should be your number one investment in your life. First things first. You want to be more successful financially? Get in good shape. Take care of your health. You want to attract, better quality people into your life? Get in good shape. Take care of your health. Anything. You want to play sports at a higher level? Yeah. Get in good shape. Take care of your health. Do you want to live a happy life? Yeah. Get in shape. Take good care of your health. But now, even more than ever, if our health care system starts to fail because there's no money, you're not going to have a choice, guys. So you might as well start stepping up right now. 10 good reasons, and 10 good reasons because you may be forced to do that. Forced to do that. And with respect to me, I've taken good care of myself my entire life. That's always been my number one investment. And with respect to any kind of tips I can give you that apply to me, that I've used my whole life, and that I use, supplements, I hardly take any supplements because they just haven't proven to be, there's no conclusive proof that supplements work. But some do. One is vitamin D. I don't have to take too much vitamin D because I'm down here in San Diego, and I run around with my shirt off, so I get plenty of vitamin D. Another one is vitamin C. Just take vitamin C. And the two other ones that I use are quercetin and zinc. And those have kept me from getting colds or the flu for over 25 straight years. That's all I take, guys. You can take there are other things you can take, sure. And I do take a few more, but I'm not going to mention them to you. Those are the most powerful ones right there. Vitamin D, vitamin C, zinc, and quercetin. And what does zinc do? Zinc prevents colds and the flu. What does quercetin do? So zinc is the bullet. Quercetin is the gun that puts the bullet into play. And it works so well, guys. And it doesn't cost anything. So just, if you don't do anything else, take 3 supplements. D, zinc, and quercetin. Just start there. Anybody can do that. I'm not asking you to, take, 10 or 20 different vitamins every day like I used to when I was a kid, just to cover the bases. You don't have to do that because most of them are just a waste of money. Just take those 3 and then go to the gym, get an annual gym membership. Don't do it on your own. Just go join the gym and start working out. And do it slowly. Go 15 minutes, then do 20 minutes. And all of a sudden you'll start feeling better and looking better. Then you'll do half an hour. And then you'll get up to, depending on your age, of course. 10 years ago, I used to go to the gym and do 10 or 12 exercises before I left. I'm 15 years older. Now I do six strong ones. And I only go to the gym twice a week. And then, so not only in addition to lifting weights, which is mandatory, you have to take care of your heart. You need aerobic training. And I'm not talking about walking down the sidewalk with your poodle on a leash and walking around the block, 2 times. Is that better than nothing? Yes. Is that a lot better than nothing? Not really. You got to go out and you got to get on a treadmill there at the gym, and you got to crank that thing up to a speed and crank the elevation up to something where your heart's going and you're sweating, because that will work your heart, and that's the key to longevity. Taking care of your heart. Why lift weights and all that? 1, it makes you look good. And 2, it takes care of your bones. And why is taking care of your bones and your muscles strong? Especially when you get older, because it keeps your butt off the ground. Last thing you want to be doing is falling. So you have to take care of your legs, because that's your fountain of youth. Forget about upper body. You want to forget about, upper body makes you look strong. Lower body makes you invincible. You won't fall. And so, because when you start to get older and take a fall, that in a lot of instances, that's the end of you. You're gonna die soon thereafter for some reason. Now you're sick, you can't walk around, you get some illness or disease. So that's my health tip for this time.
Where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
They can go to realestatetiming.com, just like it sounds, realestatetiming.com, and they can learn about what I do, how I think about things. I don't have to follow a lot of indicators, you guys. Everybody's out there, how about this indicator? Forget about it. You don't need that. You don't need that. It just overly complicates things and confuses you. If you just focus on key indicators, you'll be so far ahead of everybody else that it won't be funny. But realestatetiming.com.
Bob, thank you so much for being on This Week in Money.
You're welcome. See you again soon.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Robert Campbell. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.